Okay, everybody, hi there. This is the 18.1 economic policy notes we started in class. Just a quick overview. This chart shows discretionary spending. This is what the federal government can control. This is mandatory spending. Just to give you some ideas of numbers. These first two items were all about attempts by Congress and the President in the 1980s and early 1990s to place limits on spending. Remember, we're talking about fiscal policy, actions taken by Congress and the President to affect budget, increasing or decreasing government spending, increase or decreasing tax policies. Fiscal policy, the domain of the Congress and the President. Okay, so Gramm-Rudman was a law that was put in place to cap or limit federal spending. And every year that Congress or the President would not agree on certain cuts, there would be an automatic cut called a sequester. Your notes in the 7.5 screencast also talk about the Budget Control Act and the sequester that was used under the Republican-controlled Congress and President Obama. So one of the things that was interesting about the Gramm-Rudman Act is that the Supreme Court eventually ruled that the formula for determining automatic cuts to be unconstitutional because it took away power of the president to execute laws the way he or she would see fit, which I found really interesting. Okay, so if you ever come across Gramm-Rudman, either on the Unit 7 exam or on the AP exam, it's one of those examples of trying to put controls on spending by Congress and the President. Okay, that includes sequester. The other item that might show up either on the Unit 7 exam or it could show up on the AP exam as an example of putting caps on spending is the Budget Enforcement Act of 1990, which set limits on discretionary spending. Remember that discretionary spending is government spending that is not required by existing laws. Usually defense is the biggest discretionary spending item. Okay? The idea was if Congress spent more in one discretionary area, it would have to cut in another area to pay for it. This law naturally expired basically in just over 10 years' time in 2001. So basically the law was good for 10 years, and then it was not reenacted. And that happens. That changes in administration. So 2001, we left an 8-year Democrat run with President Clinton, and we had President George W. Bush in 2001. It could be different political party leadership in Congress. Those kinds of things can all affect change, right? So fiscal policy, there's the political aspect of it, isn't there? And also interest group aspect, right? So policy making is impacted in a number of different ways. Okay, so in this next slide, we made observations about these charts, and we actually took notes, right? So the observation here was that the vast majority of income revenue is income tax revenue. Remember, this is personal income tax, but also those types of smaller business organizations that pay their business tax through personal income tax. So you could also see this as small businesses. We also see Social Security taxes. Okay, so that's going to be taxes that are taken out of everybody's paycheck called payroll taxes, also known as FICA taxes, which is Federal Insurance Contributions Act. Just a general idea here. Notice here corporate income tax at 12%. Okay, so revenue side and then spending side. So we see the vast majority of our spending is going to be mandatory spending. It's going to be very hard to affect changes. Then we've got non-defense discretionary and defense discretionary, a much smaller piece of the pie. And this is what those Gramm-Rudman and Budget Control Act and Sequester Acts were all intended to focus on, right? If this is mandatory, this is where we can make cuts. So when you think about a $19 trillion debt, it just tells us that it's very, very complicated and complex and difficult to make cuts. Then remember, we had some nice observations here about just different kind of discussions on spending and entitlements here, and how Social Security spending is affecting a smaller increase, but then the big, huge increase is Medicare, right? That's health insurance for those 65 years and older. And over my adult lifetime and your adult lifetime, we're going to see massive increases in the cost of Medicare, and it's going to cut into our gross domestic product. So right now we see roughly Social Security and Medicare at roughly 6% of GDP. By 2080, we're going to see Medicare at 12% of GDP. That's double. That's just going to put pressure on resources and cost and spending, and the ability of Congress to be able to, engage in sound fiscal policy, if more and more of the pie is becoming more and more mandatory, how are we going to make changes? So one thing I mentioned in class was that, look, well, how can we make changes in mandatory spending, which was a good question. And we can pass new laws that make changes, but remember, any changes to Social Security and Medicare are going to affect the future recipients, not current recipients. So it's not as if all of a sudden the wool's going to be pulled out or the rug's going to be pulled out underneath of senior citizens who are currently collecting benefits. It's going to be for us down the line that are going to see those changes. What did I say today? Look, if I'm 42, I'm going to not graduate. I'm going to retire when I'm 70. So what's that? 28 years from now. So, wow. 28 years from now, this is going to be problematic for me, right, receiving these benefits. So likely we're going to see law changes over time to deal with this. Again, the domain of fiscal policy. These are where elections can be won or lost, both at the presidential level and at the congressional level. This is where presidential debates occur around these major spending issues. Okay, so next was marginal tax rates, okay? So this is kind of related to kind of history of taxation in the United States. So income tax in the U.S. is progressive, all right? The more you earn, the higher percentages you pay at higher levels. That's the definition of a progressive tax. Then with income tax at the federal level, we have these so-called marginal tax rates, which means that as you earn additional segments of money, you pay additional higher tax rates. So over here, you see a breakdown of marginal tax rates for 2016. So you see here at the first $92.75 of annual income, everybody pays 10%, irregardless of how wealthy or how poor you are. Then moving on up the scale, okay, so this chunk of money, okay, you're paying at 15%. Then if you earn annually between this chunk of money, you pay at 25%, etc., all the way up to the top rate, which is currently at 39.6%, okay? So this little explanation here, everyone, even Bill Gates, pays 10% on his first $92.75 of income. Okay, then people pay into the next level at 15%, 25%, etc. Okay, so in other words, you pay a higher percentage on the additional or marginal income you earn. All right, so you're not paying 39.6 on all this income, right? Everyone's paying at the various levels. All right, just a couple side notes here. This is right from your textbook, which I thought these were just interesting food for thought on what characterizes taxation, and we've got 3/4 of Americans who earn the least money pay about 12.5%, and 10% who earn the most money pay about 70%. So the vast majority of our income taxes are getting paid by those at the wealthiest levels, as per progressive tax, also known as the ability to pay principle. All right, so this is not on the test, but just for fun, okay? Maybe you've heard your parents talk about this. This is a very weak little picture. It's not very clear, but you kind of get the general idea. This is Form 1040. Okay, this is the tax return that you return to the IRS, the Internal Revenue Service, by April 15th following a tax year. Okay, so tax year runs Jan 1 to December 31, and your tax return is always due on April 15th. Okay, so this is what I call a tax equation. So this gives you a general idea about taxation. And while this is not on the test, this is just good background knowledge, not only for your life, but also just if you're going to be writing about, maybe an economic policy question, taxation policy question on the AP exam. I think it's just good to know this, okay? So again, not on the test, not in the book. This is just something I'm adding here, okay? So when we're calculating income, every year your employer is required to give you a W-2 form. The W-2 form is your total or gross income for your job for that year. It also outlines all the different taxes you've paid with that particular employer. And for every job you have, even if you have, say, 3 part-time jobs, you need a W-2 from each of your employers to file your tax returns. So you add up your total gross income. Then you take out what are known as personal exemptions. And so there's a set amount of money for every person that is in your household. And usually for a single person, it's 1 exemption. But so, for example, I have 2 children, so we've got 2 dependents, so we've got actually 4 personal exemptions, myself, my wife, and my 2 children. Then we have various deductions, okay? So in addition to exemptions from taxation, we also have things that we can deduct from our total tax bill. So for example, any charity that my wife and I contribute to, the mortgage interest payments we pay on our home mortgage, Those are all examples of deductions. The amount of money we spend on childcare for our child below the age of 5 who's in preschool, because both of us have to go to work, we get a deduction for paying for a portion of that childcare. Okay, so that encourages both my wife and I to go to work and earn a living, because we can deduct part of our childcare expenses, which, as you know, childcare can be costly. Okay, so there are basically two routes on deductions. There's what are known as itemized and standard. So standard is everyone gets the standard deduction, but an itemized deduction is if your deductions exceed the standard amount, you can itemize and you can take even more deductions. Okay, I'm going to come back to the idea of deductions at the very end of this screencast when I talk about President Trump's proposed tax reforms. And we're going to come back and talk more about deductions, okay? So, total income, take out exemptions, take out deductions. That's our taxable income or our adjusted gross income multiplied by our marginal tax rates, okay? The rates we talked about on the previous. Then any additional credits, okay? So, the federal government gives certain incentives through credits, such as the per-child tax credit is one where this is additional money we take off of our tax liability. Then we subtract out all the money we've withheld from our paycheck throughout the year as allowed through the W-4 form that we filled out, and that's where we get at the end any additional tax we owe or a refund. Okay, the reason why people get refunds is because they've withheld more than they actually owe. Okay, and that's what causes the refund. So I like to say that it's always good to try and shoot for no refund and not owing any money. And the reason why I say that is because if you don't get a refund but you don't owe, or it's really close either way, it's a small refund or you barely owe, that means that you estimated just right what your withholding should be, and all the money that you didn't pay to the federal government in taxes that you would get back in a refund, you had available to spend elsewhere, maybe invest, maybe put in a savings account that earns interest. So that's just a little rundown of the tax equation, okay? I wish I had more time to do it more justice, but that gives you, I think, probably maybe a better picture than before. And this is something you could show your parents and you could ask them about. They might be actually really interested in hearing what you're learning about taxation and or shed some light on taxes, okay, from their perspective. And if you already have been working, you already have been paying into at least Social Security, okay? Any federal income tax you pay in, you should get back in a refund just because you don't earn that much. But all the Social Security and Medicare, you won't get that back. Okay, so another interesting little chart, okay, shows general taxation rates. Okay, so percentage rates of both the individual and the corporate level. So what were basically the top percentage rates? So holy cow, check it out. World War II and Korean War, we had marginal tax rates at the top bracket at 100%. Quiz question for you real quick, just for fun. What's the current top rate? Think about it. If you said 39.6%, you are correct. That is the current, under current tax law, the current top marginal tax rate, 39.6%. But remember, what was it during World War II and the Korean War? Wow, nearly 100%. Now remember, that's marginal, right? So obviously someone's not paying 100% of their income, but that highest level chunk would be paid at 100%. So that's kind of like almost an incentive at that point to stop earning money, right? If you're going to have to pay all of it in taxes, okay? So both at the individual and the corporate level, we see what over time in the 20th and 21st centuries, okay? We see reductions, right, in both individual and corporate levels. So your top levels are not at historic lows, but are pretty significant lows, okay? Pretty significant lows. Historic lows would be down here. Remember, when does the taxation start at the income level? Well, the 16th Amendment to the United States Constitution, ratified in 1913, authorizes federal income taxes. Pretty amazing, right? A constitutional amendment to levy taxes. Okay, again, based on ability to pay, progressive tax. So you see in the first half of the 20th century, you see significant growth here over time in rates. Interesting. Okay, here we go. So Republicans and wealthy agreed they would agree to higher tax rates in exchange for generous tax loopholes. And Democrats at the time, way back when in the early 20th century, were willing to support loopholes if it kept rates higher for wealthier people. Now, when I say loopholes, that kind of has a negative connotation, right? But there's a lot of Americans today that you capitalize on these so-called, I'm using air quotes, loopholes that are actually the personal, the deductions that I talked about here, like deducting for, you know, I pay, what, $7,000 a year, let's say my family pays $7,000 a year to our lender, our mortgage lender, in interest that then can be deducted from our taxes, right? Some would call that a loophole. Some would call that, well, that's a deduction that encourages home ownership. All right, so when tax policy was first getting started, basically, look, it was, we're going to have really high rates, but we're going to have a whole lot of tax loopholes. And so, as your reading suggests in the Wilson AP Gov textbook, the very early tax years, we didn't have people paying a lot in income taxes, okay, because there were so many loopholes. Yeah, we had these very high rates, okay, but that didn't mean that we were paying a lot, at least in the early part of the 20th century, okay? So tax loopholes we've already kind of defined. These are deductions that can be used to reduce one's tax burden, amount owed. And again, examples of loopholes that were around for a long time. Interest on home mortgages. Interest on car loans is no longer around. Amount paid in state and local taxes. Well, property tax, believe it or not, is deducted. Okay, so, let's say my family pays for, $3,500 a year in property tax to Clackamas County. Okay, that is part of our deduction, right? So we take my family's total income, we take out all four of us get an exemption, then we've got these deductions, okay? And the deductions are, like I said, so property tax, right? So incentive to own property, okay? So that's a nice little bonus on our tax return. Right? So my point here is that for a lot of the early taxation years, major loopholes, right? And people just kind of were getting along with it. But there were then times of war when we definitely needed more income, right? And so we saw kind of some need for some reforms over time, all right? So all citizens, even the wealthy, did not pay much until after World War II. And again, for obvious reasons, right? We are rebuilding Europe after World War II. We are, greatly expanding infrastructure in the United States. We are paying war debt, etc. Okay, a lot going on. All right, so just a kind of a little broad picture. So like on an AP exam, generalizations about taxation, you're going to say low rates, right? So top rates are really low compared to other parts in history. Steadily on the decline in the latter half of the 20th century, especially in the 1980s under President Ronald Reagan, which we'll look at in just a minute. Okay. We see an evenness of corporate and individual income taxes really for the first time in history. And again, talking about President Trump's proposals, I don't know if these are going to pass or not, but I feel like it's pertinent to be talking about those because that's what's going to be proposed. That's what's going to be debated due to the results of our last election. So interesting debates, right? Also, we see, we've got President Roosevelt, President Truman, both Democrats, President Eisenhower, Republican. President Kennedy was known as a little bit of a tax cutter, as you can see here, pretty significant tax cutter at the start of his administration, even though he's a Democrat. And then we see just the major reductions under President Reagan, and then under President Reagan. That's 1986. Okay. All right. Next. All right. So this chart, again from your textbook, is just interesting. So this also puts it in perspective, right? So tax burdens in democratic nations, and I'm pretty sure this is from 2008. All right. So in terms of where we fall as Americans, throwing aside all marginal tax rates, all those things, just in general, what's basically, we call this like the effective tax rate. How much are we actually really paying in taxes? And we see the United States lands at about 11.3%. And I guess I think about my tax situation, and I think, gosh, that probably sounds about right when all is said and done, as compared to Denmark at 30.5%, Turkey at 30%, Poland 25%, Sweden 21%, Greece 17%, Canada 15%. You get the idea here, right? That type of economic systems, more free market, more socialist, those kinds of things all come into play as to what exactly the situation of each country is. Interesting, Switzerland, known for it's a kind of a banking center of the world at extremely low rates. All right, so interest groups played a huge role in maintaining tax loopholes that would advance their interest. And so, interest groups, you guys, I emphasize this early in the course. It will be emphasized throughout all of our final units on how public policy integrates with the branches of government. So we've got home builders wanted to support mortgage insurance deduction because they wanted to have incentives to buy homes, right? They wanted people to buy homes. Nonprofits like universities, think churches, LaSalle, everybody, right? They all want to see incentives for people to donate to those various institutions. Insurance companies supported the deduction for medical insurance premiums, which we don't have anymore. At least to my knowledge, we don't. I guess I would want to stand by. I just Googled to make sure, and I was wrong. So the IRS lets you deduct medical costs on your tax return as long as they are more than 10% of your adjusted gross income. Taxpayers who are 65 or older can still use the previous 7.5% threshold to claim itemized medical expenses through the 2016 tax year. Okay, so let's kind of break this down. Okay, so 10% of adjusted gross income. So if your medical expenses exceed 10% of adjusted gross income, those excesses can be deducted from your taxes. So let's take a look. Here's the tax equation again. Okay, so this is where your taxable income is, your adjusted gross income. All right, so you can take that deduction if your medical expenses exceed the 10% level here, okay? So just kind of an interesting connection back to the tax equation. Bottom line is that insurance companies want that deduction, right? So my point is, interest groups are lobbying. They are lobbying members of Congress. They are basically lobbying the president to say, look, in your fiscal policy decisions, don't take away these loopholes, all right? And this is what's being debated right now with the new Trump tax plan. President Trump tax plan is reducing a lot more of these loopholes, okay? So in the latter portion of the 20th and 21st centuries, rates have decreased while tax loopholes have been solely eliminated at various times. And the biggie reform is the Tax Reform Act of 1986 under President Reagan. And it basically, we saw a flip-flop. So instead of higher rates with big deductions, loopholes, there were lower rates with much smaller deductions, right? And so individuals gained, businesses lost, but in the end, we saw reductions in income tax rates, and at the same time, reduction in loopholes. So like, people now say loopholes are things like, corporations who offshore and they store their money in offshore bank accounts to avoid taxation and those kinds of things. Those are kind of the loopholes we know about today. Those are also some of the things that are going to be looked at to be reformed. Okay, last slide. Another major tax reform tax decision was the American Taxpayer Relief Act of 2012 under President Barack Obama. What it did is it took the top tax rate and moved it back to the President George W. Bush levels of 39.6%. I think the lowest it got was around 33% under President George W. Bush. And so again, elections have consequences. Fiscal policy, Congress and the President. Politics and voting, your votes, who you sponsor, who you support, who you like, the party you belong to, those all have impact on fiscal policy decisions. Now, the interesting thing about the American Taxpayer Relief Act of 2012 is that the President Bush-era tax cuts for many other income levels were retained. Okay, so President Obama, a Democrat, more liberal progressive thinker, would fall on the Keynesian scale of Keynesian macroeconomic theory of increased taxes, increased government spending. However, what's become rather bipartisan today under the Democratic leadership of President Obama and now President Trump is the idea of middle-class tax cuts, middle-class tax relief. I don't think any politician would knowingly campaign on middle-class tax increases. And so the question basically becomes today, folks, from the more liberal Democrat perspective is tax the wealthiest 1% on the Democrat side, tax corporations on the Democrat side, and on the Republican side, we've basically got across-the-board cuts. And so not on the test, but President Trump's tax proposal, 2017. The general idea is to reduce tax loopholes even further, simplify tax rates, limit tax on business income, relying on macroeconomic growth to make up for the reducing in taxes. Because it's like, wait a minute, how can you reduce taxes but then also massively increase defense spending, which is what his proposal is going to be? And the argument is going to be along the lines of supply-side economics, right? That the lower tax rates across the board are going to fuel all sorts of expansionary fiscal policy, right? The idea of cutting taxes fuels more availability of money to be spent in the macroeconomy, okay? That impacts the circular flow, all right? So this is basically, if Secretary Clinton had become President Clinton, I would be outlining her plan here, okay? And it would look different in terms of the proposal. So we're going with what we've got here, okay? So note, these are just a couple of pieces of campaign materials from the Trump campaign. I was trying to find something that would give you a good sort of glimpse as to what the proposal was. And there were different news articles out there, and I just found that this gave you a glimpse of what the proposal could be. This is not an actual bill. This has not gone into effect. This is not on the test either. It's not a bill that's gone into effect, but I thought I would show you. So I'm going to give you a bigger screenshot. We'll kind of go through this, and then we'll call it good on this screencast. Stand by. So real quick, again, this is campaign material, folks. So again, this is just their plan. So you can see these here, tax the goals, tax relief for middle-class Americans, right, which is very similar to here and here. Simplify the tax code, grow the American economy, right? We're going to use macroeconomic growth. Doesn't add to our debt and deficit, was their campaign promises, right? So the idea of we're not going to increase deficits, which is going to add to our national debt. That's always something that's debated out there, okay? I'm going to now give you a larger picture of this because you can't really see it. Okay, so interesting little background here. The campaign material says when the income tax was first introduced, just 1% of Americans had to pay it. It was never intended as a tax most Americans would pay. The Trump plan eliminates the income tax for over 73 million households. 42 million households that currently file complex forms to determine they don't owe any income taxes will now file a one-page form, saving them time, stress, uncertainty, and an average of $110 in preparation costs. Over 31 million households get the same simplification and keep on average nearly $1,000 of their hard-earned money. So, for those who still pay the income tax, the tax rates will go from the current 7 brackets to 4 simpler, fairer brackets that eliminate the marriage penalty and the alternative minimum tax while providing the lowest tax rate since before World War II. Okay? So remember those progressive rates from earlier? Sorry, I meant to hit pause there. You got all those different slides, but what we just saw, the 7 brackets becomes 4. So up to 25,000, the proposal is, okay, and that's single filers, married filers, and those who are head of household. You're going to pay 0% up to 25,000, up to 50,000, up to 37,500, 10% up to these limits, 20% on the marginal additional to these limits, and 25% to the marginal additional of those limits. So down here, with this huge reduction in rates, many of the current exemptions and deductions will become unnecessary or redundant. Those within the 10% bracket will keep all or most of their current deductions. So you're going to get all your deductions. Those within the 20% bracket will keep more than half of their current deductions, 20%. Okay, so what's that? Up to $300,000. Those within the 25% bracket will keep fewer deductions. Okay, so those that are married or single, $150 a year earned income. Married filers, $300 a year and up. And charitable giving and mortgage interest deductions will remain unchanged for all taxpayers, right? So that's kind of one of those biggies that interest groups wouldn't want to see change. Okay, simplifying the tax code and cutting every American's taxes will boost consumer spending, encourage saving and investment, and maximize economic growth, right? Circular flow. Okay, so this is the proposal. We'll see what happens. This is kind of a nice way to end in terms of taking what we're learning in fiscal policy and applying it to the present day, although nothing on this particular plan would show up, obviously, on the AP exam. This is also not going to be on our test, as indicated here and here, but it just gives you context kind of where we're going next, and I think it's good for your lifelong knowledge. So thank you for listening to my fiscal policy screencast in its entirety. If you made it to the end, good for you. I really appreciate your studying, your effort, your determination. I hope it pays off for you on a strong test score in Unit 7 and also more preparation for the AP exam. Thank you. Goodbye.